Hey, welcome to another episode of Break Away from the Rat Race. And today I have the pleasure of speaking with Chris Vermeulen. Chris is a financial expert who challenges conventional investing wisdom, and he believes that investors should only own rising assets. With over 25 years of experience, Chris shares an alternative investment style called Asset Revesting that allows investors to achieve higher returns, lower drawdowns, and profit from bear markets. Chris even wrote a book about it called, what a better title than that, Asset Revesting. Chris will share some of the main ideas behind his book and why this approach is the way forward. Chris believes that investing should be about capital preservation first and then growth second. And make sure you stay till the end of the show because Chris has a wonderful free offer for you. Chris, welcome to the show.
Hey, thanks for having me, Eric. It's a pleasure to be here.
All right, so let's talk about, just give us a little bit of a brief overview of your book, Asset Revesting, and kind of where it stands. And then I want to contrast that with what are people doing wrong about about investing in general?
Sure. Well, asset revesting is I put a name to it because it's very different than the current ways that people kind of trade or invest in the market. So you've got active traders, and then you've got passive investors who buy and use the buy and hold strategy. And both of those are generally extremes. Doing nothing, it can be very dangerous. Being really active can be dangerous. We'll probably touch on to that with some later on here. But the strategy kind of falls in between, and it really does just enough to take advantage of wave-like patterns that happen in the market using technical analysis. And, me being a surfer, I like to look at the stock market just like the ocean. When the tide is going up, we know it lifts pretty much all boats. When the tide's going down, say boats go down. Well, the stock market is the same. In a bull market or a rising market, most stocks go up, and in a falling market, they go down. So the whole theory here is if we can follow price using technical analysis, which you and I will touch on in a little bit, we can tell when the market is going up, down, or sideways, and when we want to be involved or move to a different asset class or investment, or take advantage of falling prices. And so we can identify these waves, and when something has got lots of momentum, we can move into that asset, hold it. When it starts to break down, just like a surfer out on the ocean, they sit out there waiting for a set of waves to roll in. And that's what I do as an investor. We wait for a very strong momentum for some assets to come rolling through with momentum, with some trends. And then we pick the asset class that best suits us and our risk profile. We jump on that wave, we ride that trend. And if you're a surfer, then you know when it's about to break, when you need to carve out, because there was a lot of momentum and it'll start to stall. And we do the same thing. So we identify and patiently wait for these sets of waves that go through the market. There's about 5 to 12 waves a year. It's not very active, but it's just enough to take advantage of the market so we can catch the upside and we can avoid the downside in stocks and bonds and other commodities even, and profit from them if we want to as well. So that's kind of what it is in a nutshell. I don't believe in buying and holding it. I don't believe in trading all the time and turning it into a high-risk job that is very stressful, emotional in the market. So
Yeah. So a lot of people, my thing is that a lot of people, when the stock market goes up, like, it has gone up like for 10 years, and then everybody think they're an investment genius. And then they're in that fallacy mode that, oh yeah, well, but really, I mean, I'm thinking all the way back to like even, what's that, 2000, just before the dot-com crash, everybody was investing, everybody was making money. How is that possible? And then we had the similar experience over the last 10 years after the great financial crisis, and when things started picking up again. And then we've been in this mode that, oh yeah, everything is great. Investing is so easy. We always make money. And then everybody's a genius again. So that's kind of like that fallacy that people fall under. And they all think that they're doing, they have a method, they have the magic method, something like that. And then, but when the market starts going sideways, starts going down and stuff like that, the true professional, the people that have like a true methodology, they survive that because they know how to survive the bear market as well. And this is one of the things that you're talking about in your book as well, about being able to be successful also in the bear market.
Mhm.
In fact, just before you get started on that, one analogy is that you can't play tennis with only a forehand. You have to do backhands every once in a while. So you should
Yeah.
you should know the backhand. And it's the same thing with the stock market investing. So tell us more about that and kind of like that fallacy that people, and what kind of errors in general, mistakes people are making when they're in that mindset that nothing can go wrong and all that.
Yeah, so a lot of it, I always kind of break the investment world or the stock market kind of people into two groups. You've either got the active traders and you've got the passive investors. And maybe we'll start off with the passive investor first, which the biggest mistake in my belief is diversification, buying into the whole story of going into dividend paying stocks and leaving your money and split it across a bunch of assets, which, you know, some will do very well. Some of them will do very poorly. And that's how you end up with a really average return that everyone knows. Like, you know, if you invest in the stock market over the long run, you're going to have 4 to 8% return on average. There's going to be a heck of a roller coaster ride through there. But doing nothing is really painful. The diversification really nulls out any performance you have, and you have zero protection from a bear market. And it's just inevitable. They always happen. COVID was a flash bear market. 2022 was a little bit of a bear market. I think we could be coming into a much bigger financial reset actually going forward, which I call it, which is considered a stage 4 decline, which we'll touch on later. But from a passive investor's point of view, it's holding on to assets that are going down and literally not putting any effort into trying to protect your capital. And people think that diversification, spreading your money out, is protecting it. Well, if the markets are going down and we're in a recession and a financial reset or bear market or collapse, whatever you want to call it, almost all assets go down. And if they all go down, how does diversification help you? It's just maybe you don't fall quite as much as just holding one particular asset. But I believe that when the tides change, we want to change gears. We want to have that backhand that when the market's collapsing, not only are we avoiding it, but we're watching our accounts skyrocket and push higher. And what I really like about falling markets is they fall about 4 to 7 times faster than they rise. So you can have a bull market for 7 years and make a certain amount of money. And then you could have a 1-year bear market and make the same amount during that falling market potentially to the downside. So there is huge potential, a lot of power. Fear is one of the most powerful, emotions there is. When people are scared, they will do absolutely anything, including dumping their shares. So that's why the markets fall. When they get scared, they just exit all assets and bail out. It doesn't matter if it's stocks or bonds or real estate or businesses. People get scared. So that's kind of the main problem, I think, with passive investors. And they kind of have this, I call it, I almost feel like they have Stockholm syndrome, because the whole financial industry has been built around this buy and hold. There's ETFs out there that are like an all-in-one. They make it so simple to diversify and buy dividend stocks and all this stuff. And everybody thinks just buying and hold is the low risk way to do it. To me, it's a very high risk way to invest. And so what investors do is they not only buy in and believe it's the best method is just buy and hold, but then they go even further and they buy companies' individual stocks that they like. And they'll tell their advisor, let's go buy, $50,000 of this stock, and I like this other one. And the problem is, by them diversifying even more into these individual companies, those individual stocks move a lot faster than, say, an index does. So when we do go into a financial correction, their portfolio drops even faster because those little individual stocks drop like a rock. A lot of them will fall 30, 50, 80% in the period of a bear market. So that is the main problem with passive investors. And the flip side is the active traders who believe that you need to trade more to make more. And they chase the charts all around with daily and weekly fluctuations. And there have been numerous studies in North America, Brazil, Taiwan, and they did, a lot of them did similar studies that if you're an active trader for 300 days or more, even during a bull market phase, 97% of them lost money.
Mhm.
And that is huge. It is unbelievable how much emotions get in and cause people to buy high, sell low. It sounds so ridiculous because we hear it all the time, but
Yeah.
it is the truth. And people's emotions drive their decisions.
Yeah.
The more you trade, the more emotional you are. It is not fun being emotional. It's day trading and short-term trading is high risk. And the odds are the more you trade, the more you're going to lose.
Mhm.
And, it's just another extreme. You don't want to go to two extremes. They're never good. They might work for a little bit. As you said, you could be in a 10-year bull market. Everybody thinks they're a genius, in late 2020, when all the stocks and growth stocks were through the roof. But now most of those growth stocks are down anywhere from 50 to 85% right now. Even after this year's strong stock market rally, they're still way down there. And that's the problem. And the whole reason I'm trying to bring asset revesting kind of to the front is because I believe most investors in the stock market are like 45 years plus. They have the most wealth they've ever had. They're retired or close to retired. And I believe we're coming into a financial reset that could devastate retirements, lives, things like that. And I saw that growing up as a kid. Actually, we went through a bankruptcy when I was younger. And I remember hearing my mom scream, and then I hear footsteps as my sister's running. I hear my sister screaming. And of course, I'm running and I see my dad in convulsions and having seizures. We had no idea what it was. My mom's trying to call 911. My sister looks back at me thinking like dad's dying. Like it was the scariest thing. And it was because we had gone bankrupt.
No.
We went from top of the food chain, doing very well. He was retired, but got back into the game because he's an entrepreneur, got in with the wrong investors who literally took the money and vanished, left him and the investors with nothing. And he lost friends, he lost families because they were investors, family members, and the stress of lack of sleep and all that put him into seizures, and it almost killed him. So it really touches home when I see this many people in the world about to like walk into the ultimate storm. It might only last a year or two, but the last time we had a setup like this is actually just like the 2000 tech bubble that you mentioned earlier. And it took 12 years for the stock market to come back, for the SP 500, 16 years for growth stocks to come back. There was over 6,500 suicides directly linked to falling equity prices. Just between 2008, 2009, that was a smaller
Talk about
correction.
emotion, right?
Yeah. So that's why I want to try to bring this forward and try and protect everybody, saying, listen, if worst case scenario, you just avoid the markets, you don't have to get, a little more aggressive and profit from falling prices. You could just sidestep it, keep your wealth, let everything reevaluate, and then you can step back into the market, back into real estate. All kinds of great things are coming. It's just a matter of not losing it when it's unfolding.
Yeah, I mean, I want to touch on it. Obviously, there's a lot of unpack here, but diversification. So when you're diversified in the stock market, you're not really diversified. As you mentioned, I mean, the whole stock market goes down, your stock is going to go down. It's not about the value of the company. It's about, the stock market is going down. And this is where I was in 2000. I had a lot of stock options, and I managed to sell I had millions of dollars in stock options, and I converted some of them into stock, and in a diversified portfolio. I own over 100 different stocks and stuff like that. And the dot-com crash happened, and basically that just wiped everything out. It didn't matter what stock I was invested in. I was investing in the stock market, and the whole stock market went down.
And what you just said there, Eric, is what most people don't understand.
Yeah.
The stock market is one asset. It doesn't matter if you own 1,000 stocks in it. It is technically it's one trade. It's one position, one asset. It goes up and down together. Some of them will buck the trend, but that's not the point. The key is you have to look at stocks as one position, spreading out over a bunch. And people just don't get that. They think they need to own all kinds of sectors and companies and spread it out. I'm like, hey, when the markets go down, they're all going down. Some might not fall as fast, but they're all going down.
So that's why I'm talking about diversification in different asset class. So if you own some stocks, that's great. It's great for liquidity, and hedge your bets. Also invest in other asset class. That's why real estate, I think you're doing the same as well. You have different investments in real estate and storage and stuff like that. So I think that's what's important. That's the if you're going to do diversification, it doesn't mean multiple stocks in the stock market. It means diversify out of the
exactly. And the strategy that I deploy is we only own, when we go into the stock market type of this particular strategy for asset revesting, we move into one asset at a time. We only hold one. We use kind of a hierarchy of which ones are the most volatile, and we move down the list. So as the markets get more wild, we move to slower moving assets. And so if the stock market's favorable, we are 100% long the stock indexes. We want to ride it up. If the stock market falls out of favor, we don't move to different stocks. We actually move to bonds. We could move to the dollar index ETFs. We can move to just a cash position and collect interest if nothing is meeting our criteria. And so that's what we do, is we literally move to a different asset. We don't just shuffle to a different pocket of the stock market. And real estate is another asset class, and all these different things. And I think everybody needs to have a diverse, portfolio way beyond the stock market. And I move in and out of the stock market constantly. Sometimes I don't have really any stock market holdings at all if they're not favorable. So,
And I think in terms of emotion too, I think this is absolutely critical. You have to be, it's a professional sport. Investing is a professional sport. So you can't be emotional. You have to have a game plan. If it's in the stock market, you have to know before you buy let's start with real estate. Before you buy a property, an investment property for resale, you want to do a flip, let's say. You want to know what you're going to sell the property at. You want to know how much it's going to cost in renovation. You want to know how long it's going to be. You want to know, there's a number of things that you want to consider before you even sign a purchase and sales agreement. You want to know all that information. You want to verify all of that before you go into that decision. And the stock market or other investments is the same thing. You want to have, before you go in there, you want to have an expectation that, okay, well, if I buy it, I want to buy it at this price. I can sell it at this price. How long am I going to hold this? Or how long, what kind of return am I looking at? That's the kind of thing that you have to make that calculus up front. And you may say, well, right now it's too high a price to buy. I'm going to wait, or blah, blah, blah. So,
well, you bring up a good point, which is, a lot of people don't have the proper expectations. A lot of people don't do the research. And the financial industry, if you move into the active trading side and you follow newsletters and you're, into stocks and options and all that stuff, everybody seems to get pulled into like, oh, I can make 30, 50, 100% return a year. I can trade all these fast moving stocks and options. And while, you can potentially do that with a very small portion of your portfolio because it's a high risk strategy, it's not the reality of how you're going to make money in the markets. There is no quick, easy money to make massive returns. The bigger the returns generally carries more risk. And people have this expectations that if they go in active trade, they should be able to make 25 or 50% a year, but it doesn't work that way.
Exactly. Same thing in real estate too. People expect, oh, wow, you're making this much money and stuff like that. But you look at the return, like the annualized return, or look at this, look at that. And they're always looking for these unicorn deals that you're never going to find them. I go through thousands of deals. I've gone through thousands of deals over the last, 10 years that I've flipped. And, the average return, like the actual profit was, a certain number, let's say $10,000 to $15,000 profit. But people look at that and say, well, this is not enough. This is like, well, what do you want? No, I want to make $50,000. Based on what? What kind of information
you need a bigger project, more money.
So, all right. So we know that everybody sucks at investing. So that's one. We've established that, I think. So let's talk about revesting. So what does that look like? How does that methodology work? What problem does it solve?
Right. So how it works is more or less asset revesting is giving you back or someone taking control of their capital instead of just letting it sit there and rot and ride the roller coaster ride of the buy and hold, or to be actively traded and slowly get whittled away to nothing. what we're doing is we're just saying, hey, listen, there's beautiful waves in the market. We are going to take our money, we're going to put it into a strong wave, a nice momentum in whatever asset or index that is. And when it stops going up, we're going to identify that using technical analysis, which is moving averages, and you can use cycles and price action. And when it starts to slow down and change direction, we pull our money out. And then we sit in cash and we look for the next opportunity, and then we'll move to the next asset. There's no point in holding something going down. If the charts can tell us and we can visually and identify if something's going up or down, why would we hold something going down? So asset revesting is just simply moving or reinvesting our capital just consistently into assets that are rising in value. And if you do that, then your account is just slowly ratcheting higher and higher and higher, whether the market goes up or down. And that's what we see a lot of people really, they're blown away with. They're like, the market goes up, our account goes up. The market rolls over and sells off, our account keeps going up. They're like, it blows their mind when they're like, oh my gosh, why did I hold through these big waves in the market when I can take advantage of them? So from a really high level, I mean, that's all that we're doing is identifying price charts. So a little story is I started trading when I was 16 in high school, eventually made enough through college to pay for my college. And then the tech bubble hit. And I pretty much lost all the money on my account because I was buying companies, small cap stocks back then, because I was really aggressive. And they had good earnings
at that time. You see,
they had good earnings, and even though they were beating earning expectations and growing,
they were making money.
Pardon?
They were making money.
Well, not all of them were just tech companies that were broke. They were just small cap companies.
Tech companies were losing money. Incredible.
Yeah, no, tech wasn't really making money, but there's lots of small caps making money. But even though they were growing, some of these little companies, the share price cut in half, then it got cut in half again, and I watched all my money vaporize.
Yeah,
and that was when it hit me. I'm like, okay, this fundamental stuff is ridiculous. Like fundamentally, this thing should be going up, but I just lost all my money. And that was when I Googled and searched. I'm like, what is another way? Because I was taught just follow PE ratios, fundamentals, all that stuff. And fundamentals are the key. I learned that didn't work. And I stumbled across technical analysis. John Murphy, who's like the godfather of technical analysis. Read his book, and Martin Pring, you name it. I've read all the big books. I'm tired of reading technical analysis stuff, but they teach you how to follow chart patterns and how different assets are interwoven, and they move. Everything's connected in the financial system in some way. Something goes up, something is getting money pulled from it to go into that asset. If stocks are falling, that money is flowing into a different asset class. So that is the key, is to understand it. And once I decided, oh my gosh, if I just follow technical analysis and follow the price, and I can tell if it's going up, down, or sideways, all I got to do is just pick the stocks or the ETFs to trade when I know they're going up or down, and I can consistently pull money from the market. And I'll just find a bunch of different assets that are not correlated. So stocks could be going down, another asset could be going up, or if both of those assets are going down, I could move to a different thing, which, I rotate between stocks and bonds and currencies and a cash position. They all move on their own free will. They can all go in their own direction. And it doesn't matter if the dollar is falling or if the dollar is rallying, there's an ETF for it. You've got an inverse ETF. So that's the nice thing about it, is there's always something that you can move to that has lower volatility, low risk, that you can keep squeezing money out of until kind of the core asset, which to me is the stock market, is back into a favorable wave or new bull market that's tradable.
All right. So you mentioned, kind of like, I like the wave analogy and stuff like that. And but how do you identify that? So I know you mentioned technical analysis, but what specifically? Because the thing about technical analysis is that you have, even looking at the charts, I mean, you look at Head and Shoulders, and then you zoom out, and then, or you zoom in, and then the Head and Shoulders is gone. You reduce the time frame. It's, oh, there's no Head and Shoulders here. That's an upward trend. You zoom out, then it's just a blip. You don't really. So that's kind of it's kind of like, what kind of time frame are you looking at? What kind of how do you? It takes some expertise, I would say, to really kind of like look at technical analysis. And then you have people that also are looking at they have kind of a bias because they're looking at history, and say, oh, you see, if I had done this in the past 2 years ago,
Yeah.
with this pattern, I would have gone to this level. So now I see this pattern here, and then all that means it's going to go to this level, but it's not always true, especially if you believe in the random walk theory. So, so tell me about the technical analysis. I'm a skeptic on the technical analysis, I must say. So, but sell me on that technical analysis and kind of like how you approach it.
Sure. So I guess analogy would be look at the stock market like an onion. There's layers. And so you need to look at the stock market many layers deep. And then you also need to, look at the big picture view and look at many time frames on top of that. So each time frame has got different layers between momentum and trends and money flows between different assets. So the way I look at the markets, generally, I look at the big picture. I want to know maybe on the weekly chart, or for sure in the weekly chart, that we are in a bull market phase. If we're in a bull market phase, then I go to the daily chart and I say, okay, are we in a short term, like in a rally mode, in an uptrend or a downtrend, or is it just choppy and we don't want anything to do with it? So then let's say we identify we're in an uptrend. Then I want to look at some moving averages, make sure their price is above them, make sure they're sloping up. I also like to look at cycles. There's time-based cycles in the market where there's just money flows on a monthly and quarterly and even a yearly basis. There's all kinds of different cycles that play into the markets. And then I also like to look at a lot of different assets. What are utility stocks doing in relation to the stock market? Are they outperforming, underperforming? People go to utility stocks because they're usually high dividend paying. No matter what, kind of recession we get, we still need electricity, running water, all that stuff. Same with consumer staples. They're a defensive play. Is money moving into the defensive plays, or are they going into growth and biotech stocks? Precious metals, money flowing into the precious metal space. Are people worried about the dollar? Are they worried about stocks? They want to own something physical. So there's all these things are interwoven. And to me, that allows us to get an idea from the big picture. Is there a big tide? Is the tide going up? Are we just like catching a fresh new wave? Money is flowing into the right pockets in the right direction. And when you put all those things together, we can, from a data standpoint, and even from the charts, we can see these things unfolding. And we'll be like, okay, this is a beautiful uptrend. It still has lots of room to go, or momentum. We want to move in and catch this play. So, I mean, there's a lot that goes into technical analysis. A lot of people think it's voodoo. You might not it might not be your thing, but it actually works very, very well if you don't get sucked into the million indicators and stuff. And I think the key thing is a lot of people look at indicators, a lot of indicators, and they layer them on. The thing is, indicators are based on the same thing. They're pretty much all based on price, most of them.
Yeah. So
you're really just comparing a bunch of different ways of the same data, and some say buy, some say sell, and that's why so many people give up on technical analysis. You need to look at cycles, which is time. You got to look at time frames, which is big picture, small picture. We look at money flows into sectors. So what is the sentiment? Are they getting nervous and going defensive? Or are they getting bullish? We look at volume flows. Is money pouring in? Are they buying on the ask, saying just buy me at any price, just get me in? Or are they dumping shares on the bid? We follow the New York Stock Exchange money flows. So every layer of the onion is using a different type of analysis. So when you put it all together, you're like, that's the trend. This is what we've got. This is what the markets are saying. And then we move in and we take advantage of that. And when all those little pieces start to erode, and enough of them erode, we're like, you know what? Let's move on. Let's go find a fresh wave and do our research and then move into that asset. So that's how I go about it. It's very different than most others. I take a very technical aspect, and I like to look at it from every possible angle. And every angle is a different type of data on that asset.
So is systematically, do you look at a certain number of charts every day to figure out what's going on, or do you have some sense from what you're reading in the newspaper or what you're doing in watching TV, famous CNBC or something like that, and then you kind of you have some kind of theory about or belief about where the stock market is going to go, or a sector of the stock market is going to go, or a specific stock even, and then say, okay, well, I think I'm going to look into that a little bit further and see if this is confirmed by some data that I'm seeing, and then I make a move.
Yeah. So I'm almost going on 13 years that I really haven't read other people's opinions. I don't read the newspaper. I don't watch TV. I don't read the news. If there's breaking news, something big, usually my 11-year-old or 13-year-old kid, my son or daughter come running in and they're like, "Dad, did you hear about this?" So I run very clean and clear. I hate news. It's always negative. I don't need to. News is unpredictable. People who trade off news and the Fed and all that stuff, to me, it's completely ridiculous because you don't know what they're going to say. And then even if they say what you thought they're going to say, you have no idea how people are going to react. You have no idea how the algorithms are going to go. If you understand the underlying trend, even if the news is against that trend, it's usually just a blip on the chart. People panic and it creates a 1-2 day blip. And then things kind of recoil and the markets continue. So zero news, I can't stand it. It's, to me, it's a huge waste of time. It's all negative energy anyway. In terms of, what was your other question there? Your other question was
well, and then you go, so so now you're not doing the news. So where's your main source of information then? Do you have
right.
Do you have a thesis about kind of where the economy is going, where the stock market is going, where a stock is going?
Right. So, I mean, other people don't need to do this. I do this because I share with people every day, but I have my charting platform set up. I've created custom indicators and all my analysis. So I always go through the charts every day. I just like to see what's going on. And at a very quick glance, I can see what every sector and commodity is doing. It's all organized in a way that I can tell right away. I'm like, are people nervous today and they're doing nothing? Are they super bullish or are they bearish? So I can see which way the market kind of biases are going. But I also have a setup on my platform that it does almost all of the analysis for me. So it's telling me in color coding the bars saying, hey, own this asset and you should be along this asset and these ones are out of favor, or vice versa. It tells us where to get in, where our targets are, where our stops are. So it's taking all this stuff, which is nice. It just kind of runs automated. And whenever there's a trade signal, then I will manually put in the trade myself and send it off to anyone who's following our signals and trading those. So that's kind of how I go about, and I follow the markets.
Okay.
The reality of trading, and most people don't want to hear this if you're an active trader, is, I mean, I've been doing it for over 25 years. I live and breathe it. I've worked with over 25, actually, I think it's around 27,000 different traders over the years with my newsletters. It's a rotating door. I'm still learning. You have to constantly adjust. The markets are a living, breathing organism. And people think they can just go into it and trade more and make more money and follow these newsletters. And I mean, the newsletter business is a rotating door. I have seen thousands of people come and go. They have great marketing and they suck people in and choose them up and they spits them out, a few months later. The reality is, if you're not going to commit the rest of your life to following the markets and learning and understanding and putting systems in place and strategies and be able to get over your emotions and follow it, you're best to follow something that's already done for you and is done right, or don't do it at all. And that's the biggest thing is, and that's one of the nice things about real estate is the stock market it's an unbelievably difficult challenge. Real estate, which I think everybody should own some, you can really fumble through it and still do all right, as long as you don't maybe buy in a peak, and then you got to hold things a little longer for it to come back. But the stock market, it's not that story. You either get the right data and do it properly, or commit your life to it and expect it's going to take at least 10 or 15 years to really feel like you're in the zone and you live and breathe it and you know what to expect on a daily basis and be able to project forward, the volatility and all that stuff. It's a very difficult business to be in.
Yeah, and I think a lot of people go into this, like especially the consumer go into the stock market thinking it's more like a game than anything else. So I think it's important to have a system in place and be disciplined about how you invest and how you a strategy in place so that you're doing the right thing. To me, it's a sports analogy is like kind of like a golfer or a pro tennis player or something like that. I mean, they take notes about especially the golfers, they take notes about this golf course, this is the weather condition, all that kind of stuff. This is how I did this hole, and the hole was positioned there on the green. This is what I did. And then, so the next time I play that course, then I can make adjustment and correction that is going to benefit me.
Yeah. Surprised you haven't mentioned pickleball yet.
Well, yeah,
I
that's
swear everybody plays pickleball.
yeah, I play pickleball as well. I'm not at that stage where I actually take notes, but yeah, so I just started since I moved here. I started playing pickleball, and now I'm in with a group of people that they're pretty intense. So I have to pick up my game literally. So, Chris, that was anything else you want to add here about your revesting system?
I think we covered a lot. I mean, one thing we never touched on were the stages of the markets, and I actually have which actually kind of leads into, if I can mention, if they go to my website, which is assetrevesting.com. It's just a landing page. You can get on from this webinar, this podcast. You can get into the newsletter and get our quarterly market analysis for asset revesting. And it goes into these, you'll also be able to download this infographic, which is the 4 stages of the markets. And we should just touch on that really quickly, because the 4 stages really is the foundation of the markets. And this infographic has got 3 diagrams on it. It breaks it from the 4 stages that the market moves. You need to know what stage you're in because they require different strategies to trade with or invest in. The next one is on the human emotions of what people think and feel during certain times.
Yeah.
And then, of course, we've got the cycles, which are what assets perform better or worse at different stages of the stock market cycle and the economic cycle. And when you see the market broken down from these 3 different point of views, and you put them all together, you get a very, very good understanding of what to expect, how to trade, which assets you should be looking at. And, the 4 stages work is more or less, stage 1 is a basing formation. The stock market is flatline. It's kind of trying to find a bottom. It's not going anywhere. It's a difficult time. You don't really want to be trading it or investing. Stage 2 is a bull market phase. We all love these. They can last 3 to 10 years or so. And then we get into a stage 3, which is what we're in, I think, right now in the overall economy and the stock market, which is a choppy markets. Things are slowly breaking down behind the scenes. A lot of layers of the technicals are breaking down, and it's a difficult time. And then, of course, the bottom falls out and we go into a stage 4, which is like the 2008 financial crisis. It's the tech bubble crisis. It's a reevaluation event of stocks, commodities, currencies, real estate, businesses. We've already seen business valuations from a venture capital standpoint go from ridiculous valuations to like now they're like almost feel like they're undervalued compared to that. So it's happening. And that's why this brings us full circle of why I'm trying to talk about asset revesting, because we're coming into a point here where you need to protect your capital, or you could suffer not only financial loss, but mental, physical health. It is a very stressful life when you lose everything right when you need it and want it the most. And that's what, I'm trying to help people understand, but it's a different point of view, a different style of trading. Asset revesting is for somebody who has a financial advisor. They're going to be like, well, 5 to 12 trades a year, that's really active. And then you go to an active trade and they'll be like, that's not enough trades. I can't make money on 12 trades. So, there is money to be said where no one is. And the strategy is right in that zone where people will lose interest because it's too slow. And somebody who doesn't know anything thinks it's way too much. But it's just the way it is. I mean, it's all in my book that I talk about, and you and I covered a lot of it today.
Oh, that's good. Thank you. Can you repeat that the free offer again? What the link is to get basically subscribe to your quarterly newsletter?
Yeah, so it's the Asset Revesting quarterly newsletter. It's a $250 newsletter, but you can opt in, you can get it for free, and that'll keep you in the loop. Every quarter we come out with a video. We just actually posted one this week. So you know what stage we're in, where we are, what assets you should be looking at, what you should be thinking over the next 3 months that could be happening. It's just a good taste of what is going on, so you can maybe help manage your portfolio of real estate, of stocks, of your businesses, whatever it is. Because having the mental game, understanding where we are in these cycles, if things start to erode, if you're mentally prepared and invested to be protected from those, oh my gosh, life is a game changer. It's a pretty incredible experience when you understand the market cycles and movements, and you're not only know they're coming, but you're actually prepared for them.
Yeah. Well, thank you for that. And if people want to get a hold of you, they want to reach out, what's the best place for them to reach you?
Yeah, the best spot they can go to, my core website is thetechnicaltraders.com.
Yeah.
They can reach out to me at support@thetechnicaltraders. And that's I'm there if they got any questions.
Excellent. I'm also going to put in the description a bunch of your social links as well. So, people like to kind of look at you from all the different angles. So, Chris, it was a pleasure speaking with you. Good luck. And again, so if you go to the technicaltraders.com and then to have more information about the overall Chris's basically methodology, but also I'll also put the free offer as well for the newsletter as well in the description. So Chris,
Excellent.
Thank you very much.
Thanks, Eric. Pleasure.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.